Welcome to AION Powerhouse, the deep dive. SpaceX prices Thursday after the bell at $135 a share, a $1.75 trillion valuation, the largest IPO in market history by a factor of 3. Today we are pulling apart the actual thesis under the headline number, why Goldman's book is multiple times oversubscribed, why Morningstar is calling fair value at $780 billion, and what an allocator should actually do in the 48 hours before SPCX starts trading.
Yeah, and I mean, what's so fascinating here is just the absolute immediacy of the situation.
Right.
Like, this isn't some theoretical discussion about, the future of space commerce in the 2030s. You, as the allocator, are exactly 48 hours away from a historic liquidity event.
Literally right around the corner.
Exactly. And to survive Friday morning, we really have to establish the dual reality playing out right now, because there's a massive, highly calculated gap between what the retail buyer on Robinhood thinks they're buying and, well, what institutional allocators are actually underwriting when they place their bids.
Okay, so let's unpack this and drop right into the raw, hard deal mechanics to ground us.
Let's do it.
We're looking at a fixed price of $135 a share. And notice, there is no typical IPO price range here. It's a total take-it-or-leave-it dictate.
Yeah, completely fixed.
So SpaceX is raising $75 billion, yielding that staggering $1.75 trillion valuation on roughly 555 million shares. But here's where the plumbing gets incredibly strange.
The retail anomaly.
Exactly. We are seeing a 30% retail tranche. That is about $22.5 billion flowing directly through Robinhood, SoFi, E-Trade, Fidelity, Schwab. To put that in perspective, that is 3 to 6 times the normal retail allocation for a public offering.
It's massive. And while that retail block is being marshaled, the institutional book is already multiple times oversubscribed as of Tuesday's close.
Which is wild.
It is. But if we connect this to the bigger picture, you can't just look at that $1.75 trillion number in a vacuum, You have to look at the pre-IPO valuation ladder, because it tells the story of aggressive, systematic markups that should really make any public investor pause.
Walk us through that timeline.
Sure. So let's look at the sheer magnitude here. In June 2024, the private valuation sat at $210 billion.
Okay.
By December 2024, it stepped up to $350 billion. Mid-2025 hits were at $400 billion. Then by December 2025, following that huge fortune scoop about the 2026 IPO tender marker, just doubles to $800 billion.
Just off the scoop.
Right. Then in May 2026, just weeks ago, it traded at $950 billion on the NASDAQ private market. And now, Friday, June 12, 2026, they are asking the public market to swallow $1.75 trillion.
So, what does this actually mean for you as an allocator? Because I really have to push back on this momentum.
Thanks for it.
This is a 5x markup in exactly 12 months. And it was captured entirely by existing insiders before the public ever touched a single share. Is this next leg up actually for you, the public market participant? Or are you just providing unprecedented exit liquidity for the insiders?
Well, that is the $1.75 trillion question, right? Mm-hmm. And the only defensible way to figure out who is the mark and who is the winner at this valuation is to tear open the S1 filing itself.
We have to bypass the retail hype completely.
Entirely. We need to look at the actual cash engines driving the business.
Let's do a cold walk of the segment table in that S1, because fiscal 2025 consolidated revenue came in at $18.7 billion. But the secret of this document is that this is not one company.
No, not at all.
It's 3 highly distinct businesses just welded together under one ticker. Business 1 is connectivity. So that's Starlink plus Starshield. They generated $11.4 billion in revenue with $7.2 billion in adjusted EBITDA.
And we should probably define EBITDA real quick for anyone listening.
All right, good call. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's just a clean measure of cash profitability.
Right. And at $7.2 billion, that gives them a staggering 63% margin. Let's contextualize that for a second. Microsoft operates around a 45% margin. AWS back in 2008 was about 65%.
Wow.
Yeah, so this isn't aerospace economics. This is pure monopolistic software and infrastructure economics.
Exactly. But then you have business 2, which is space. That's the legacy launch services, Dragon, and the Starship program. That segment pulled in $4 billion in revenue, but only $650 million in EBITDA.
Which is a 16% margin.
Right. It's a capital-intensive, lower-margin industrial business. But then you hit business 3, which is AI.
And this is where it gets interesting.
Right. So this encompasses XAI, Grok, and X, which were absorbed in that February 2026 reverse acquisition. They showed $3.2 billion in revenue, but they are carrying a massive, bleeding negative $6.4 billion operating loss.
And see, right there is the disconnect. Because hidden deep in the footnotes of that S1 are these massive compute contracts that are basically propping up that AI wing.
Right, like the Anthropic deal.
Exactly. Anthropic is paying XAI $1.25 billion per month for Colossus data center compute through May 2029. And Google has a $920 million per month compute contract locked in.
So institutions are fully underwriting this locked-in AI compute revenue.
Yes, they are treating SpaceX as the hyperscaler of last resort. Meanwhile, retail is basically buying the romantic narrative of Elon Musk and a colony on Mars.
That is the core reframe you really must adopt before Friday.
Absolutely. What you are actually buying when you click buy on SPCX is a highly profitable infrastructure business, which is Starlink lashed directly to a deliberately cash-burning AI venture.
With a sovereign defense-funded launch business acting as the stabilizing bridge in the middle.
Exactly. The institutional buyers are not buying the same thing the retail tranche thinks it's buying.
Looking at the segment table is analytically true, but it doesn't give the human brain anything to really latch onto, you know?
Right, it's just numbers.
Yeah. If you're going to actually trade this on Friday, you need a unified mental model. I want to give the listener something to actually hold in their head, because the segment table is true, but it doesn't click. Here's the analog. SpaceX in June 2026 is Amazon in 2001.
Okay, I'm going to test that violently. What do you mean exactly?
Think back to 2001. The market priced Amazon purely as a struggling book retailer, right? AMZN had IPO'd at $18 in 1997. It was sitting at $6, priced like a low-margin storefront.
Sure.
What the market completely missed was that Jeff Bezos was using that bookseller cash flow to quietly fund AWS cloud computing. It was a technology that literally had no existing category at the time.
Right, nobody understood it.
Exactly. And the investor who held AMZN through that wildly overvalued decade got the AWS re-rate completely for free. By 2011, AWS wasn't just a side project, it was the entire business case. Today, Starlink is the bookseller cash flow. It's printing cash at a 63% margin, and it is quietly funding the invisible business.
Okay, I half buy it. The structural analog works beautifully. A profitable, highly visible business funds an invisible category-creating business. But the parallel breaks down critically on what that invisible business actually is.
How so?
Well, for Amazon, AWS was a single, clear product with a defined category. SpaceX's invisible business isn't one thing. It's actually three massive, complex call options stacked on top of each other.
Okay, lay them out.
First, you have the AI infrastructure through those Anthropic and Google compute contracts. Second, you have sovereign-grade defense communications through Starshield. And third, you have orbital data centers, which, let's be honest, are still basically just on presentation slides.
Fair point.
So the bull case is that those three together somehow get AWS's multiple. But the bear case is they don't have AWS's product clarity, and Mr. Market refuses to underwrite three separate call options at once.
Okay, I'll accept that refinement. It is definitely more complex.
Yeah.
So let's call it this. SpaceX at IPO is a one-ticket subscription to three of the most consequential businesses of the next decade.
I like that.
Global broadband through Starlink, orbital-grade defense communications through Starshield, and frontier AI compute infrastructure through XAI. The visible business in 2026, Starlink funds the entire flywheel. The only question is if Friday's price is fair for all three.
And this brings us to a critical test for the listener. Here is your test. If you can hold all three of those distinct businesses in your head when you allocate Starlink, Starshield, and AI compute, you are sized for the institutional thesis.
Right.
But if you can only hold one thing in your head, Mars and Musk, you are sized for the retail story.
Yeah.
And honestly, you are the exit liquidity the institutional book is using.
But this raises a huge red flag for me. If the bull case relies on holding three complex options simultaneously, what happens when the foundation of those options starts to show cracks?
You're talking about the bear case?
Exactly. We need to systematically tear down the risks. Let's walk through the 6 fundamental bear pillars using the actual S1 data.
Okay, let's start with pillar 1. Mars is actually a return destroyer.
Wait, really? The whole brand is Mars.
I know, but Musk delayed the Mars timeline by 5 to 7 years in February 2026, just 4 months before this IPO. He pivoted Starship toward a lunar moon city instead. Musk himself blinked. The timeline is broken.
So public retail investors are paying a premium for a narrative that just got pushed out a decade.
Precisely. Which brings us to pillar 2. Musk concentration is empire-level systemic risk.
The key man risk.
It's massive. There are 38 pages of risk factors in the S-1 naming Musk's death, distraction, or disability as the top risk. There's $38 billion in cumulative federal exposure.
Yeah.
Plus, the New York State Comptroller just sent a warning letter on May 13th about this exact thing.
And we can't forget the corporate entanglement. Tesla owns 19 million SPCX Class A shares.
Yes.
If Tesla blows up, SpaceX stock takes a mechanical hit from the forced selling.
Exactly. Okay, pillar 3. Starlink growth is actually decelerating. Their ARPU is down 18%.
Let's define ARPU real quick.
Right. Average revenue per user, it's down to $81 a month, and Indie approvals stalled again on June 9th. Plus, Amazon Leo Ultra is officially a massive threat.
Yeah, Leo Ultra is offering 400 megabits upload and 1 gigabit download, and it has AWS Direct Connect. That is a real threat to Starlink's highest margin enterprise tier.
Which brings us to pillar 4. Government contracts are politically reversible.
Because everyone assumes Starshield is a guarantee.
It's not. A 2028 administration change could push Pentagon spend right back to legacy primes like ULA or Lockheed. Right now, under % of the NSSL Phase 3 Lane 1 is anomalous.
And NSSL is the National Security Space Launch, the Pentagon's main launch procurement program, right?
Exactly. And that revenue will get spread around upon renewal, which ties into pillar 5. Reusability is being competed away on a 24 to 36-month horizon.
Right, the moat is shrinking.
Rapidly. Rocket Lab's Neutron rocket launches Q4 2026 at $55 million per launch versus Falcon 9's $74 million. That is a 20% undercut. So launch margins will move from monopoly to commodity just as public investors are demanding EBITDA growth.
Which leads to the final one, pillar 6, precedent risk. 94 times sales is Saudi Aramco territory.
Yeah, and we saw how that failed to hold in public markets.
Exactly. WeWork is the textbook private to public markdown. Morningstar's $780 billion fair value is only 44% of the IPO price.
So synthesizing all this, every one of those 6 pillars is real. The bear case isn't that SpaceX is a bad company.
Not at all.
The bear case is that the price is wrong, and the structure of who gets paid first during a correction is completely wrong for the retail buyer.
Okay, so with the upside framework established and the downside risks mapped out, we need to shift from theory to action. What exactly should the listener do with their capital on Friday morning?
Let's give them a 48-hour playbook. 3 concrete moves.
I'll start. Move 1. Decide your frame before allocating. If you are buying a standalone broadband monopoly, you are size constrained to roughly a $280 billion sum of parts valuation.
Sum of parts, meaning?
Basically valuing a company by independently assessing each of its distinct business segments and adding them together.
Right.
Now, if you are buying the AI infrastructure re-rate, you need to size for a 12 to 18-month thesis. And if you're buying Mars, you're buying retail conviction. So size accordingly. Just decide before the bid.
Move 2. Price the Musk discount explicitly. You must demand a 200 to 400 basis points cost of equity premium.
And basis points are just hundredths of a percent, so that's 2 to 4%.
Exactly. You demand that premium for the dual class structure, which is a voting structure where Class B shares carry 10 votes to Class A's 1, giving Musk about 79% voting power, plus his regulatory exposure. That's 35 to 70 billion of value missing from the price. You want SPCX to print below 135. Buying above 160 means you are paying for pure retail euphoria.
And move 3. Watch the day 2 and day 3 tape. If SPCX floats above 160 in the first 3 sessions, lock partial profits as institutions sell to retail. If it prints below 125, the bear thesis is already in play, and Morningstar's $780 billion fair value becomes a cleaner anchor.
And we have to point out the second order read here. Every space, defense, and AI infra name Rocket Lab, AST Space Mobile, Palantir, CoreWeave, they will all reprice around SPCX's trading. Privates will re-anchor too, Stripe at $159 billion and Dural at $61 billion. OpenAI at $500 billion plus.
There's a crypto angle too. This is basically Arthur Hayes' AI debt thesis applied to corporate finance. A $75 billion raise absorbs massive liquidity right as Treasury issuance scales. The marginal dollar funding this IPO is a dollar that did not fund Bitcoin this week.
It's a macroeconomic sponge.
Before we wrap, here's a final provocative thought. When you look at the sovereign-grade launch capabilities, the global satellite network, the frontier AI compute, are we even pricing a corporation anymore? Or are we essentially watching the IPO of an unregulated, privately funded nation-state that's packaging the romantic ambition of spaceflight to quietly finance the infrastructure of a global AI war? It really changes how you view the ticker.
SpaceX is the most defensible, most concentrated, and most politically exposed company ever to come public. Priced at 94 times sales 48 hours from now. The question is not whether you believe in Starlink. The question is whether you believe in pricing three companies at the same multiple in the same instrument inside the same controlled vehicle. Defensible answer either way. Just make sure you know which one you've answered before you click buy.
That's today's AION Powerhouse Deep Dive. If SPCX prints outside 125 to 160 on Friday, we'll be back inside 48 hours with the post-trade read. Until then, come back tomorrow.
That's your AION Investor Briefing. Stay informed every weekday. Subscribe now and download the AION app at aionpowerhouse.com.